Hey, what's going on, guys?
Yeah.
Pay up now because you'll be rewarded later. Don't fret it.
Well, the good news is that you don't really have to pay up. You may have to pay up relative to where stocks were selling 2 months ago, but look at the top 10 performers today. Every single one of them, pretty much, is a financial or an energy stock. Wells Fargo, GE, Oxy, ConocoPhillips, Simon Property, Ford, Capital One. These stocks are still down 40, 50% from their highs.
Good news. Good news on the vaccine front. And as I said back in April and May, Scott, it's going to be like the roaring 20s. I mean, we followed up.
Today I wanted to talk to you about 3 monthly dividend stocks that pay at least 5% yield or higher. And they're pretty safe bets. If you're new to investing or you don't know too much about stocks, most stocks that pay a dividend pay it on a quarterly basis, every 3 months. But there are a lot of monthly dividend payers out there. You just have to be very careful about which one you choose. You might look around and say,
wow, some of these stocks pay 9, 10, 11% monthly? Yeah, I'm good. I'm gonna start buying 100 shares of that.
stop. Do your due diligence, do your research, make sure that company is a safer long-term bet. You don't want to invest in a company where, it pays you that 9, 10% monthly dividend, and then over the course of year to year, the capital gains start going down. You may have bought it at $20 a share, and after a year and a half, it drops down to 10 a share. Now you've lost 50% of your money just to get that high monthly dividend. No good. The name of the game is to not lose money, it's to gain money. Also, the stock or ETF might have an expense ratio attached to it where you're getting that high monthly dividend, but you have to pay a 2% expense ratio, otherwise known as a fee. And we don't do fees on this channel, and I'm here to make sure that you don't do fees either. Also, the stock may be inconsistent with paying that monthly dividend. They might pay it for a year and then stop for another year because they're not hitting their company's earnings or their goal expectations. So always do your research before you invest in a high dividend paying stock, or any stock for that matter. But the stocks I'm going to talk about in today's video hit all 3 criteria. They have very little to no expense ratio attached. They consistently pay that monthly dividend over a very long period of time because they're meeting all their goals and earnings expectations. And they're also growing in share price, and the capital gains are actually rising over time. So not only are you getting that steady monthly dividend, but your stock is actually growing. That's what it's all about. So if you want to know how to generate lots of monthly dividend income, just sit there and keep watching this video. And while you're sitting there, make sure you smash that like and subscribe button and hit that bell for notifications, because this is a finance channel that is dedicated to helping you build wealth over time, invest wisely, and make smarter decisions with your money. Okay, the first stock that I want to talk about is Main Street Capital. The ticker is MAIN. And we see here that it pays a 7.9% monthly dividend. And what it basically is a business development company. The fund focuses on providing customized debt and equity financing solutions to lower middle market companies. The company's portfolio investments are made to support management buyouts, recapitalizations, growth financings, refinancing and acquisitions of companies with annual revenues between 10 and 150 million. It offers financing alternatives to entrepreneurs, business owners, and management teams. Main Street Capital was founded on March 9, 2007 and is headquartered in Houston, Texas. And if we take a look at the earnings, we see that quarter after quarter, they're either surpassing or meeting all of their earnings expectations. So the company has no problem generating money and paying out that steady dividend. And over the last 5 years, which is a pretty significant amount of time, they're actually up 2.1%. And I know you're saying, well, that's not much at all. But if you look here, right before the pandemic hit in February of this year, they were actually up to $44.30, where 5 years ago, they were right around like $30. So this company would actually be up 40% if not for the pandemic, or higher. So this is a company that's actually not only paying you that steady monthly dividend of 8%, but it's also growing in share price and capital gains. So you're winning on both ends, the dividend compounding over time and the share price going up, and you making money on capital gains. That's a definite win-win with Main Street Capital. Now, I personally am a shareholder with Main Street Capital. I took a position with them back in 2017 when I first joined Robinhood. I only bought a couple of shares, but I was a new investor back then, and I kind of wanted to see how this thing performed over time. But now that I see that that dividend steadily comes in and month out, and I'm pleased with its performance overall, I began to add to that position a couple of months ago. And I think that this is definitely a stock that I want to continue to build upon to grow that monthly income. Now, I got to put this out there. I'm not a licensed professional. I'm not a stockbroker. I'm just a guy who's an investor, giving you his own researched analysis and my own opinions on which stocks I think are quality monthly dividend stocks. So I don't want you to think everything that I say is gospel, like, oh, Nick said I got to buy Maine and Nick said I should buy that one. No. Always do your homework on any stock that you're looking at or any stocks that someone is recommending. You shouldn't throw a bunch of money at something that you know nothing about. So it always pays to do your homework. I don't care if Warren Buffett is recommending it. Go research what you're putting money into. All right, next up is the PowerShares S&P 500 High Dividend Low Volatility ETF. The ticker, SPHD. And what an ETF is an exchange-traded fund. An ETF is a basket of securities, shares of which are sold on exchange. They combine features and potential benefits of stocks, mutual funds, or bonds. Like individual stocks, ETF shares are traded throughout the day at prices that change based on supply and demand. So in a nutshell, basically what they're trying to say is an ETF is just like almost like a singular stock that contains many other stocks inside of it. So with SPHD, this contains 50 of the least volatile names, meaning these are names that don't go up and down dramatically. Like, they're not going to sink too low on bad news and they're not going to go up too high on good news. They're pretty much steady Eddie type of stocks. The least volatile names chosen from a short list of the S&P 500 75 highest dividend yielding securities. So they're telling you that SPHD is made up of 50 stocks that don't go up or down too much, but they have high dividends attached. And with this, you're pretty much going to always generate that steady monthly income. And over time, the stock is going to continue to grow. It's not going to go up too high at once because it's not like a single stock like Tesla or Amazon or Apple, but it will go up over time. We can see that over the last 5 years, it's up 11.6% and would be up even higher if not for the pandemic. 5 years ago, this thing was at 33, a little less. And right before the pandemic hit, it was right around $42, $43. So it went up a little over 30%, I'd say. 33.87%. So this is a stock that I recommend, honestly, because your portfolio is going to be guided on a nice even keel with it. You're going to receive that monthly dividend income. And on any bad news with this ETF, your portfolio isn't going to just drop like a rock. It's going to kind of be anchored pretty evenly. And anytime you check your portfolio, you can kind of count on this. This will kind of be like the cornerstone ETF. Oh, and by the way, SPHD has an expense ratio of 0.3%. And I thought I'd bring that up because earlier in the video, I mentioned the term expense ratio. And what that is pretty much an annual fee that comes out. You don't even realize that it's coming out, but all ETFs have them. And 0.3 is honestly on the much lower side of things. I mean, I've seen ETFs that have 1.5, even up to 2.5% expense ratios, which is extremely high. So for all the benefits that SPHD is going to add to your portfolio's performance, I wouldn't pay too much mind to that 0.3%. Honestly, of course, it would be better if there was no fee, but 0.3 is next to nothing. Yeah, so SPHD is like one of those staple ETFs that everyone in the investment community knows about. It contains 50 stocks from the S&P 500, like I mentioned before. And it's going to always be able to provide that steady monthly income because it's not going anywhere. It's not like an individual stock where you have to always focus on that one company. This is comprised of 50 companies. Its performance will always be steady and reliable. And that's what you want. When you're building monthly dividend income, you want reliability for the long term. Now, let's get to the third and final stock. Okay, last but not least, Pembina, short for Pembina Pipelines. The ticker is PBA. Pays a monthly dividend of 7.6%, has an 82% buy rating from expert analysts on Wall Street. What they basically are is a pipeline corporation that engaged in the provision and transportation of midstream services. It operates through the following segment: pipelines, facilities, marketing, new ventures, and corporate. The pipeline segment includes conventional, oil sands and transmission pipeline systems, crude oil storage, and terminaling business and related infrastructure. Yada, yada, yada. The company was founded on September 29, 1954, and is headquartered in Calgary, Canada. The listed name for PBA is Pembina Pipeline Corporation. Honestly, with this stock, you know that it's a reliable monthly dividend payer that's not going anywhere. It's been around for almost 70 years. It's the main and only pipeline corporation that both transports and stores crude oil in Canada. So they have relatively no competition. And if you take a look over the last 5 years, this thing is up 73%. I'm going to actually check it right before the pandemic hit because the pandemic skewed a lot of numbers. I'm not going to use today's numbers. I'm going to use from right before the pandemic hit when everything is normal, because it's going to work its way back up to this $40 all-time high. But right before the pandemic hit, this thing is up almost 75% over the last 5 years while it's paying you an 8% dividend. So it's another win-win situation where you're steadily growing in capital gains and you're steadily receiving that 8% dividend. And I mean, oil pipelines in Canada, they're not going anywhere. It's not like they have a ton of transportation. There's a lot of extremely freezing parts of Canada, and they have no way of getting oil around from, the northern parts of the country to Alaska, to the west coast of Canada, to the east coast. It's not like they have an abundance of roads like in the United States. It's freezing up there. So Pembina is like heavily relied upon to transport their oil. So if you're really into monthly dividend paying stocks, I recommend you take a look at Pembina Pipelines because this one is a steady payer. All right, so that does it for this video. Those are my 3 picks for very high quality monthly dividend paying stocks. So go ahead and do your own research before you think about investing in them. And if you haven't already done so, make sure you hit that like and subscribe button and hit the bell for notifications. That way I can keep bringing you high quality financial content to help you build wealth and make smart money decisions. Thanks.